Would you like to learn how to choose the best stocks for your portfolio? I'll let you in on a secret. An 8-minute video won't turn anyone into Gordon Gekko. That's why I've created 2 videos for you. You can watch the next part right here, at the same time next week. You can't say we're not giving you every chance. So let's start the Gordon Gekko training. Hi guys, welcome back. This is the Smart Invest. If you want to gain an edge over other investors in the market, it typically comes from 3 sources. The first is information. It's worth knowing that Gordon Gekko had a penchant for insider information. But I have some bad news for you. 40 years ago, they were already handing out long prison sentences for that, and the situation isn't much better today. Let's just say that there is a good chance that neither I nor any other spectator is exposed to this danger. In our case, this means gathering as much information as possible about an industry, a field, or a specific company within it, which in the case of American companies is fortunately easy for anyone to do. This is exactly why you can't really get this kind of advantage in US markets. It may work less effectively in slightly more backward markets, such as Eastern European markets or smaller Asian markets. The next possible source of an advantage lies in data analysis. This means determining what to buy or sell based on various metrics. Different quantitative analyses, filters, and access to different corporate data are easily available thanks to the internet. If you're willing to spend some money, and of course if you're smart about it, you can access well-organized, structured data that will provide you with valuable information. However, in this field, it's not easy to stand out since many others have access to the same data. Benjamin Graham, who was Warren Buffett's mentor, used to hunt for stocks in the 1950s where the shareholders' equity exceeded the company's market capitalization. In simple terms, he preferred companies with a price-book ratio below 1. These companies were easy to identify even in the 1970s with basic computers, but you won't find many like that today. If you do find one, it's essential to thoroughly research it because there might be significant issues. Sometimes it could be a sudden drop due to a bad report, like the Foot Locker case not too long ago. I took the opportunity to buy some at around $25 a share since it was trading below the price book value. I expected a positive correction after the report, which ended up being a massive crash, and the stock quickly dropped to $16 a share. My plan didn't work out, but I knew why I bought the company, and I saw it as an even better opportunity. I tripled my position just above $16 a share and sold all my shares around $22 a share with a quick, sweet profit. I could have held on for a higher profit, but there were better opportunities in the market due to a correction. That's it for the magical price-book ratio. For small investors, such basic filters are easily and freely accessible. I recommend the Stock Analyze website and FinViz, which you can find in the video description. Of course, for better services, you'll need to pay. But as a beginner investor, you can have a lot of fun with these. Artificial intelligence, AI, brings significant changes in this field. It allows analyzing not only the numbers, but also various news, quarterly reports, and analyses related to a company. You can draw intelligent conclusions from them, but these are available to everyone, or at least will soon be. The big players on Wall Street have an advantage because they can track where clients' money is moving. This is the primary source of income for free broker services. They sell your trading data to companies specializing in very short-term trading. But the third secret source to gain a small edge is your own intellect, thinking, and behavior. When Warren Buffett shares his wisdom, it's mainly about mental aspects. Investing and trading are 99% about knowing when to say no in certain situations, and this is where the mental side comes into play. In 1980, Warren Buffett advocated 6 things to gain mental wisdom. The very first point is to control your greed. This means not jumping on every hype train. Investor optimism can be very intoxicating. It might lead people to overpay for excellent companies. Nvidia, what? We all know how intoxicating investor optimism can be. As a result, people tend to overpay for good companies. For example, imagine paying 45 times the price-sales ratio for Nvidia. The second point is patience. If you're invested in a stock and its price falls without any significant change in the company's performance, be patient. History has shown that there will always be reasons to sell, like panics, wars, crises, but we've always survived them. The third point is to be unique. Be greedy when others are fearful and fearful when others are greedy. Dare to stand out. For this, you need something else. which is the fourth point. You have to have the confidence. But first, let me introduce today's video sponsor, who is none other than you. Yes, you heard it right, it's you. Being a small channel, even a simple like can make a huge difference, and if you're interested in the world of investments or would like to follow the performance of my S&P 500 killer portfolio, I recommend subscribing as well. Confidence is great, but it's even better if it's backed by knowledge, especially in investments. It doesn't hurt if you can provide a knowledgeable answer to someone asking about a company you're interested in. The fifth point is to be aware of your own limits. If you don't have the time or desire to dig into something deeply, it might be better to leave it to someone else. Small investors might find this area to be quite large, but there are passive index following ETFs for this purpose. Regarding the fifth rule, we can see that the portfolios of the most successful investors are generally narrower. For example, looking at Warren Buffett's portfolio, 90% of the money is invested in the top 10 stocks. We could also mention Nick Sleep, who is not that well-known investor but was considered by many to be a very smart investor and at one time had a portfolio of only 4 stocks. To do this, you need deep knowledge of the companies and sectors. My opinion is that for an individual investor, it's often better to have a diversified portfolio with 20, 30, or more stocks. Some might run into issues, but in a diversified portfolio, the impact is usually less financially and emotionally. Finally, the sixth point is to be flexible. Let's take Apple, for example, which we currently consider unassailable and believe that its users cannot be tempted away. But in 10 years, we might replace our smartphones with some kind of holographic contact lenses. Warren Buffett often emphasizes that the best holding period is forever, but the ever-changing world can sometimes interfere. Even Warren Buffett changes his portfolio, but in his case, it's measured in decades. These were his top stocks 30 years ago. Coca-Cola and Geico are still there, but Geico was completely acquired. So if you want to invest in individual stocks, you must follow them. If something significant happens with the company and it's not in the right direction, you should be able to say goodbye to the shares. When I sell my existing shares would be worth another 2-3 videos, so we won't get into that now, but we'll also discuss it later. In the second part of this video, coming next Sunday, we'll talk about how you can decide whether a company is good or bad using publicly available corporate data. This way, you can create a watch list of good companies, and when their valuation becomes favorable, you can consider investing. If you liked the video, found it informative, and would like to help me on my journey toward 1,000 subscribers, please press the like button and subscribe. Take care, guys, and see you on the next episode. Don't forget, don't lose all your money on the stock market until the next episode.